Hi, my name is Brittany Dean. I'm currently a senior here at Bloomsburg, and I am studying political science and criminal justice. Today, I will be talking about the role of the US dollar globally. The foreign exchange market is the market in which participants can buy, sell, exchange, and speculate on currencies. It is made up of banks, commercial companies, central banks, investment management firms, hedge funds, and retail forex brokers and investors. The currency market is considered to be the largest financial market with over $5 trillion in daily transactions. The US dollar has become very dominant in the forex market due to the Bretton Woods Agreement. The Bretton Woods Agreement was created at a conference that had all of the World War II allied nations in 1944. The agreement stated that countries promised that their central banks would maintain fixed exchange rates between their currencies and the dollar. If a country's currency value became too weak relative to the dollar, the bank would buy up its currency in foreign exchange markets. That would lower the currency supply and raise its price. If its currency became too high, the bank would print more. That would increase the supply and lower its price. That is how trading works. There are three important functions of the foreign exchange market. The first one is transfer function. The basic function of the foreign exchange market is to transfer purchasing power between countries to facilitate the conversion of one currency into another. The transfer function is performed through the credit instruments like foreign bills of exchange, bank draft, and telephonic transfers. The second function is the credit function. The second function is the credit function, and that is to provide credit, both national and international, to promote foreign trade. Bills of exchange used in the international payments normally have a maturity period of 3 months. Credit is required for that period to enable the importer to take possession of goods, sell them, and obtain money to pay off the bill. The third function is the hedging function. In a situation of exchange risk, the foreign exchange market performs the hedging function. Hedging is the act of equating one's assets and liabilities in foreign currency to avoid the risk resulting from future changes in the value of foreign currency. In a free exchange market, when the value of foreign currency varies, there may be a gain or loss to the traders concerned. To avoid or reduce this exchange risk, the exchange market provides facilities for hedging anticipated actual claims or liabilities through forward contracts in exchange. Forward contract is a contract of buying or selling foreign currency at some fixed date in the future at a price agreed upon now. Thus, without transferring any currency, the forward contract makes it possible to ignore the likely change in the exchange rate and avoid the possible losses from such change. Is the US dollar the global reserve currency? Yes, because the reserve status is based largely on the size and strength of the U.S. economy and the dominance of the U.S. financial markets. But before then, most countries were on gold standard. Their governments promised to redeem their currencies for their value in gold upon demand. As a result of the Bretton Woods Agreement, the U.S. dollar was officially crowned the world's reserve currency, backed by the world's largest gold reserves. Instead of gold reserves, other countries accumulated reserves of the US dollar. Needing a place to store their dollars, countries began buying US Treasury securities, which they considered to be a safe store of money. Today, more than 61% of all foreign bank reserves are denominated in US dollars, according to the International Monetary Fund. Many of the reserves are in cash or US bonds, such as US Treasuries. Also, approximately 40% of the world's debt is denominated in dollars. What happens in other countries affects us. The foreign exchange market can affect us as U.S. citizens, even if we aren't the ones trading it. The strength. The strong U.S. dollar is great because it makes imports cheaper. That reduces inflation and makes the cost of living less. When you buy groceries at the store that are imported, it's cheaper, as well as lower gas prices. The weaknesses. When the US dollar is weak, it increases the cost of importing, which will lead to inflation, also a lower standard of living because you will have to pay more for your groceries and gas or anything else that is being imported. And here is an example. The attack on Saudi Arabian oil facilities is a great example of this. The Dow Jones Industrial Average fell more than 100 points after an attack on Saudi Arabian oil facilities disrupted more than 5% of the world's daily crude supplies and raised the prospect of higher gasoline prices that can add a speed bump to a vulnerable U.S. economy. Gasoline prices are likely to rise 10 to 25 cents a gallon after strikes on two major Saudi oil facilities caused the largest disruption of the world's daily oil supplies. Here are my references. Thank you.